Welcome to Make Your Money Matter. I'm your host, Brad Barrett. I'm also a managing director and partner here at One Capital Management. Today on the show, we're going to talk about capital gains tax. Now, many of you watching or listening each week, a couple episodes ago, we actually talked about 10 different types of assets and how they are taxed. And a few of those on that list I brought up were actually capital gains tax oriented. And I got a few questions on that. So I wanted to spend some time, a few minutes here on the show today, and talk about capital gains and how they are taxed. So we're going to talk about what is a capital gains tax, when are capital gains actually taxed, and then ultimately how to look at or calculate a capital gains tax. Now, before we get started on today's show, it's important to note that any show we do, obviously, especially when it comes to taxes, is not a substitute for sound professional advice here. Many of you hear me say it's very important to speak with counsel, speak with your financial advisor, or in this case, on tax situations, make sure to get your CPA or your tax preparer's advice on any specific situations. And obviously, before we get started here, make sure to smash the subscribe button and click the notification bell so you don't miss a single episode. All right, let's get into it. Okay, first and foremost, what is a capital gain? Let's define it first. Capital gains are the profits you make from selling or trading what is called a capital asset. Now, with certain exceptions here, a capital asset is generally any property that you hold. So this can include investment property, stocks, bonds, real estate, collectibles even. It can also include property held for personal use, things obviously like a car or a house or maybe home furnishings. Now, there are various special rules that may affect your properties or the classifications or ultimately the treatment as a capital asset. So again, this is where you want to speak with your CPA and or your tax advisor around this. But I wanted to start with defining what is a capital asset, because once you define what a capital asset is, you'll realize what will apply to a capital gains tax rates, which we're going to be talking about here next, versus, again, maybe an ordinary income tax, which we talked about before. So the next question typically comes up with a client around when our capital gains are taxed, and they're actually taxed in the taxable year on which they are quote unquote realized. So your capital gain or loss is generally realized for tax purposes when you sell a capital asset. And as a result, capital assets can continue to appreciate or increase in value without becoming subject to tax as long as you continue to hold them. Quick aside for a second, many of you have seen this likely, but you don't realize it on your statements for your stocks or your bonds. When you see a category that says realized versus unrealized, realized is the term used when you've actually sold the capital asset. Unrealized shows a gain in the capital asset that you have not yet sold. So if you've not sold it, therefore you won't incur a tax. But if you have sold it or realized it, that will then be capital gains taxed, again, depending on the time period, typically if you own it for more than 12 months. Now, I want to touch on that for a second of how capital gains are taxed, just to give you the high level. So your taxable capital gain is generally equal to the value that you receive when you sell or exchange a capital asset minus what we'll call your basis in that asset. Now, your basis is generally what you paid for the asset. Sometimes this is an easy calculation. Like for example, if you paid hypothetically $10 for a stock and sold it for $100, your capital gain is pretty simple. It's $90. Just math there, right? But in other situations, determining your basis can be a little more complicated, especially when it comes to real estate. So again, speak with your CPA or tax advisor about that. Now, for capital gains tax rates, I always recommend looking on the IRS website because you can see them right there every year and they're updated typically every year. So again, I want you to focus there rather than kind of looking at time-stamped shows or articles you might be reading. It's always good to go directly to the source. So I really wanted to focus today's show on what a capital asset is and how then it would be taxed at capital gains, because ultimately when a capital gains tax is assessed, whether it's realized versus unrealized, and then ultimately how a capital gains is taxed matters to your what's called after-tax net return. Lastly, I'll leave you with this. Now, we spoke about gains, obviously capital gains tax a lot today because that's typically where the tax rates apply, right? But there are such things as capital losses. So you might be thinking, okay, what if you have an overall net capital loss? Like you bought something, but you sold it for less. Let me give you an example. That same hypothetical stock at $10, but you sold it for $8, that's a loss. There are special benefits that you can actually use. There's also carry forward rules that you can apply potentially to losses. Again, you can also offset other gains potentially as well. So again, we talked about gains today, but I would be remiss not to mention before we end the show today that if you have a capital loss on some of those assets that are deemed capital assets, you can actually speak with your taxpayer or your CPA to walk through how those actually might benefit you. Something here at our firm, when we do trading on after-tax accounts in our portfolios, we do things called tax loss harvesting. We're able to offset losses and gains within a portfolio. Make sure you're also speaking with your advisor about that if you specifically have after-tax accounts, things like individual accounts, trust accounts, joint accounts, things like that. Hope you enjoyed the show today. If you did, make sure to subscribe to our channel so you don't miss a single episode. And always remember to make your money matter.